Good afternoon. We're going to get started in just a moment. Okay, my name is Joe Reilly. I'm the President and CEO of the Community Development Trust, and it's my pleasure today to introduce Martin Gruenberg. Martin Gruenberg is currently the acting chairman of the FDIC, but his work with the FDIC began way back in 2005. Mr. Gruenberg joined the FDIC board after broad congressional experience in the financial services and regulatory areas. He served as a senior counsel to Senator Paul Sarbanes on the staff of the Senate Committee on Banking, Housing, and Urban Affairs. He also served as a staff director for the Banking Committee Subcommittee on International Finance and Monetary Policy. Also of note, since June of 2019, Mr. Gruenberg has served as chairman of the board of directors of Neighborhood Reinvestment Corporation, NeighborWorks. Marty Gruenberg was raised in the Bronx. His parents came to the United States in 1951 after having survived the Holocaust in Europe. His humble beginnings instilled a keen appreciation for the economic opportunities this country makes possible for its citizens. But he also has a strong understanding for the challenges faced by those who are excluded from the financial mainstream. His work at the FDIC, as well as with other federal banking regulatory agencies, has allowed him to play an important role in expanding access to the financial mainstream for all Americans. His work has helped to ensure that all Americans are treated fairly in our ever-increasing complex financial system. Sum all of that up, and Marty's a good guy. He's been a good friend of NAAHL for many years, and throughout his career, he's done work that has had a positive impact on tens of thousands of people across the country. Please welcome Martin Gruenberg.
Good afternoon, everybody. Joe, I have to tell you that was as thoughtful an introduction as I've ever received, so I really do appreciate it. We share a deep common bond. Joe grew up in the West Bronx. I grew up in the West Bronx. Can't overstate the importance of that connection. And my first job at a school, actually, was with my local congressman from the Bronx. Joe might actually... Jonathan Bingham, who is really, as I think Joe will concur, was really an exceptional public servant, really an outstanding member of Congress. And my first job was working as a legislative assistant to the congressman in Washington, but the deal I struck with him was I'd work 3 weeks a month in Washington on the legislative stuff, on urban issues in particular, and then 1 week a month I would spend in the district working on housing and community development projects. And my parents still lived in the district at the time, so I could, the deal I made was as long as I'd pay the shuttle fare up to New York, I'd have a place to stay, and he could kill two birds with one stone. I could cover both the district work and the legislative work in Washington. It was don't tell anybody, it was probably the best job I've ever had. And one of the first meetings I had was with the leading community group in the district, which was the Northwest Bronx Community and Clergy Coalition, if any of you happen to be familiar with it, which is still really a terrific group. And Joe was working for them at the time. Joe tells me we met. I won't say the year, but Joe says we met back then, which I believe, and And Joe's brother, John Reilly, is actually somebody I got to know very well and still runs an outstanding community organization in the West Bronx. So that's really a deep connection and really informed, if I may say, the rest of my career. I think the experience I had, even though I grew up in the district, it's a different experience seeing it through the eyes of the community organizations, the local financial institutions, the local government officials, and the local elected representatives. And that experience and learning about the nuts and bolts of community economic development really informed the rest of my career. It's what got me interested in finance and financial regulation, because it seemed so much at the foundation of all the work that was being done. So it's a long way of saying it's a really nice thing for Joe to be able to introduce me today. I really appreciate it. Now let me get to my speech, if I may. So let me begin, first of all, by thanking my friend Buzz Roberts and the National Association of Affordable Housing Lenders for the chance to speak with you all this afternoon. NAAHL has worked for more than 3 decades to promote inclusive neighborhood revitalization and to ensure that all Americans can find safe and affordable housing. We've had a long relationship. You're a terrific group, so I particularly welcome the opportunity to talk to you today. You all bring together banks, community development financial institutions, and others with the ability to direct capital to address needs in communities across the country. This approach has given NAAHL unique expertise to contribute to important policy conversations over the years, from tax credits to small business lending programs, and a statute called the Community Reinvestment Act that I think you all are familiar with. On this last point, and I know Buzz cautioned you not to, you can ask, I just can't answer anything about CRA today, but on this last point, as you know, the FDIC, the controller of the currency, and the Federal Reserve earlier this year put forward a joint notice of proposed rulemaking on CRA. While the comments are under review, I assure you that the agencies remain committed to strengthening the impact of CRA and to increase transparency and predictability in its application. We've received about 1,000 unique comments on the proposed rule. I must say many are detailed and thoughtful, and the agencies are carefully reviewing them as we work toward a final rule. And that's about all I can say and have to say on CRA this afternoon. NAAHL's work on both policy and practice continues to be critical. And I know the focus of your program today is on affordable housing. Today, many Americans find it difficult to find and afford housing in their communities. According to a June report from the Joint Center for Housing Studies at Harvard, the number of existing homes available for sale at the start of this year was lower than at any point since the late 1990s. New units, according to the center, were selling quickly and with a majority costing more than $400,000, carried prices that were out of the reach of many. In addition to concerns about the cost and supply of housing, recent increases in interest rates, I assume you saw the paper the reports this afternoon. Recent increases in interest rates mean that mortgage financing costs themselves will likely be challenging for aspiring homeowners in the short run. Last week, rates for 30-year mortgages climbed over 7% for the first time in 2 decades. The monthly principal and interest payment for a well-qualified middle-class family that a well-qualified middle-class family might expect to pay on a $300,000 30-year loan has increased from just under $1,300 to more than $2,000 in the last year. And while affordability issues are broadly felt, As you all well know, certain communities, including those that were most affected by the foreclosure crisis, feel its effects most keenly. While African American homeownership has started to recover from its post-crisis low, African Americans today remain far less likely, at just over 45%, to own a home than the general population, over 65.5%. In fact, at nearly 30 percentage points, the gap between African American and white homeownership rates currently reported by the census is larger today than it was in 1960. Renters, too, are facing increasing challenges. The Joint Center report details that rents across the nation grew by 12% on a year-over-year basis in the first quarter, even before the latest run-up. Renter households were shouldering significant housing cost burden. As the report notes, almost half of renter households paid more than 30% of their income on housing costs, and 24% paid more than half of their income. NAAHL's work to promote investment in housing and local economies across America is vital to ensuring that all Americans can share in and contribute to their communities. As you well know, homeownership in particular is an achievement that both opens up opportunities to build wealth and provides a foundation from which families may participate in a full range of civic and economic activities. Seen in this light, the work of NAAHL is the work of financial inclusion, which is actually the subject I'm going to focus on this afternoon. Before families can achieve sustainable home ownership, they need to develop sound financial capabilities, including acquiring perhaps the most elementary financial asset of all, a relationship with an insured depository institution. As the acting chairman of the FDIC, this is something we spend a lot of time thinking about. The FDIC has a long-standing commitment to advancing economic inclusion in the banking system. By forming a banking relationship, families gain a safe place to receive and store hard-earned wages and the ability to access a range of products and services that can help them manage their financial affairs, build savings, and establish and make use of consumer credit. Moreover, relationships with an insured financial institution come with a range of protections, including deposit insurance, guaranteed timely availability of funds, and protections against unauthorized transactions. Now, and you all may have seen some of the reports on this, since 2009, the FDIC has conducted and reported results of its national survey of unbanked and underbanked households. The survey measures the extent to which Americans participate in the banking system and highlights opportunities to expand economic inclusion. Conducted in partnership with the Census Bureau, this survey provides authoritative data at the national, state, and local level. With more than 30,000 responses, as surveys go, that is really enormous. With more than 30,000 responses, the survey also affords insight into how results differ across demographic segments of the population. Today, it's widely used by financial institutions, community-based organizations, and other practitioners, as well as by researchers and policymakers. Our most recent survey report was released last week. While the results reveal that substantial progress has been made, and I'm going to get to that, they also demonstrate that much work remains to ensure that all Americans have meaningful access to and can benefit from a banking relationship. This release marked the 5th straight survey over more than a decade to show a decline in unbanked rates in the United States. In all, 4.5% of households were unbanked in 2021, meaning that they did not have an account with an insured depository institution. To place that figure in perspective, in 2011, 10 years ago, 8.2% of households were unbanked. Put another way, the gains over the last 10 years have resulted in almost 5 million additional households with banking relationships, and those households would be expected to be comprised of over 9.5 million adults and 2.3 million children. So this, as statistics go, is pretty meaningful, going from 8.2 down to 4.5%. While it should be acknowledged that this was generally a period of economic growth over that decade that may have aided the results, nevertheless, the progress is notable. Also in 2021, the results indicate that 14.1% of households were underbanked, and that's defined as owning a bank account, but still using one of several non-bank products and services tracked in the survey. In terms of trends, the survey reports diminished demand for these non-bank products and services, which is also of some consequence. For example, the share of households using non-bank check cashing has now fallen by half over the prior 4 years, from 6.4% to 3.2%. The data also revealed declines among the share of households using non-bank consumer credit products that households may turn to for small amounts of money, such as borrowing from pawn shops, payday loans, or auto title lenders. Just 4.4% of households used such non-bank credit products in 2021. That's down from 7.4% 4 years ago. That's pretty meaningful. Think about the nature of these financial products. Even if encouraging on the whole, it's important to recognize that these aggregate results mask stark differences across the population. These differences help illustrate that substantial challenges and opportunities remain to expand participation in the banking system. While the unbanked rate among white households in the United States stands at 2.1%, unbanked rates among Black and Hispanic households, respectively, were 11.3% and 9.3%, multiples. Moreover, these gaps cannot be understood as a simple product of differences in income. At every income level in the survey, the unbanked rates of Black and Hispanic households exceeded those of white households. Among those earning between $30,000 and $50,000 a year, the unbanked rate for white households was 1.7%, but was 8% for Black households and 8.4% for Hispanic households. Other population segments also have significantly lower levels of engagement with the banking system. Single mothers, nearly 16%. Households headed by a working individual with a disability, nearly 15%. Lower income households earning less than $30,000 a year, 13.5%, and households with lower levels of formal education, those with high school education or less, nearly 10%. All of these groups were significantly more likely to be unbanked. It should be clear that the different experiences detailed in these data on home ownership, on access to bank credit, and on ownership of a bank account have significant implications. The FDIC's mission is to ensure public confidence in the nation's banking system. That confidence is bolstered when as many people as possible are connected to and benefit from their relationships with insured institutions. While we appear to have made meaningful progress since the inception of the survey, we are still far from ensuring that Americans of all backgrounds can fully participate in and benefit from our nation's banking system and economy. Now, a few interesting lessons from the pandemic relevant to this issue. In addition to providing insightful measurements of current engagement, the survey also yields important information about the opportunities to expand economic inclusion in the banking system. We learned some interesting lessons during the pandemic. For example, the most recent survey asked questions about what motivated households to establish a bank account. The results show that a sizable majority of households that recently established a banking relationship had received an economic impact payment or other public benefits such as expanded unemployment insurance during the pandemic. Among these, almost half, 44.8%, reported that the payment contributed to their decision to open a bank account. Who knew? Similarly, a slightly lower proportion, 33.1% of recently banked households reported that starting a new job said that the new position contributed to their decision to open an account. These findings point to the importance of taking advantage of these sorts of what we call bankable moments by ensuring consumers are aware of and able to locate and open bank accounts that can meet their needs. You know, I must say, when the pandemic first hit and we had a severe contraction in the economy, a severe disruption in the financial markets, we were expecting major consequences in terms of the banking system and what the FDIC has to deal with. And in terms of access to the banking system, we expected a negative impact. And ironically, it really turned out to be the opposite. During the pandemic, the FDIC partnered with the Internal Revenue Service to support consumers as they opened accounts so they could receive stimulus payments in a secure and timely manner as a direct deposit. I give the IRS a lot of credit for that. As you may know, consumers without accounts face potential delays in receiving checks and the added burden of cashing those checks during the pandemic. Together, the agencies provided resources to help consumers understand their options for opening an account, including options for opening an account online, during a time when some may not have been able or willing to travel to a bank branch in person. The FDIC also invested in a national outreach campaign to raise consumers' awareness of the benefits of getting banked. Importantly, though, and it's worth emphasizing this, it wasn't just the FDIC or the federal government that invested in these kinds of efforts. Fair to say trade organizations such as the American Bankers Association and the Independent Community Bankers Association, and nonprofit groups such as the Cities for Financial Empowerment and their colleagues in the Bank On movement helped consumers find and open accounts and really made an impact. Connecting consumers with bank accounts only works, of course, if banks offer accounts that are well suited to meet household needs. This is really the other end of the issue. You want to get people access to the bank account, but you got to be sure that the product they're getting access to appropriately meets their needs. Over the last decade, An increasing number of institutions have offered accounts specifically designed to help address the needs of a wide range of consumers, including low and moderate income consumers. These accounts, typically patterned off a template initially put forward by the FDIC, I'm pleased to say, known as SAFE accounts, feature no or low minimum balance requirements, low, transparent monthly fees, and are designed to ensure that consumers cannot incur overdraft or insufficient fund fees. The Cities for Financial Empowerment Fund certifies accounts as meeting a set of national standards that include these and other key features. So we're able to ensure people get access accounts that are really appropriate to their needs. Evidence from the survey and other sources are consistent with these accounts having their intended effect of removing obstacles to households achieving and sustaining an account relationship. One interesting result from this year's survey is associated with changes in the reasons unbanked households give for not holding an account. The proportion of households citing reasons related to minimum balance requirements or fees decreased in this survey to 28%, down from 38% in 2019. I must say, addressing these concerns were central motivations for the development of the SAFE account idea. In addition, data supports the proposition that banks are increasing the availability of these accounts. Recent work by FDIC analysts has documented that certified accounts certified by the Cities for Financial Empowerment documented that certified accounts are now available from institutions that collectively hold more than 60% of all the domestic deposits in FDIC-insured institutions. And finally, in terms of net effect, an independent analysis of data from the Federal Reserve Bank of St. Louis tracking the adoption of these accounts concluded that their availability has helped support consumer participation in the banking system. The analysis noted that SAFE accounts appear to be expanding access to banking in important ways, with a disproportionate share of account opening in areas with greater proportions of minority and lower income households. Bankable moments represent key opportunities to join the system, but we shouldn't lose sight of the importance of also ensuring that households are able to sustain banking relationships. After all, FDIC surveys have consistently revealed that about half of the unbanked households in the United States actually were previously banked, had bank accounts previously but no longer. New research from FDIC economists demonstrates that even temporary job loss can be associated with families experiencing periods of time during which they do not maintain a bank account. Financial institutions and support agencies may have opportunities, the researchers observe, to mitigate this risk if they can identify and provide timely information or material support, such as temporarily waiving monthly maintenance fees that may be triggered when direct deposits previously associated with a job cease. While the research bolsters the case for such approaches, they're not unprecedented suggestions. In fact, during the pandemic, bank regulatory agencies encouraged financial institutions to be accommodative in a similar fashion, including by waiving ATM fees as families struggled with challenging conditions. Final issue I want to touch on is the difference in utilization of non-bank payment sources between people who hold account, households that have accounts, and those that don't. The survey helped bring to light the extent to which households are turning to an increasingly diverse set of providers for financial services. Almost half of households reported they had used a non-bank online payment service in the past year. The survey specifically asked about online payment providers that had a feature that allowed consumers to receive and store money with the service. This is an important, I think, line of sight into the utilization of these payment services. While banked households were significantly more likely to use non-bank online payment services than unbanked households, the most common use cases were very different between the two groups. Banked households most commonly reported that they use these services primarily to send or receive money from family or friends and to make online purchases as a complement to a bank account. In contrast, the most common use cases among unbanked households revealed that they were using these services as they might otherwise have used bank accounts, paying bills, receiving income, and as a vehicle to save or keep money safe. Other results for unbanked households showed that they were more likely to hold a prepaid card and were also more likely than banked households to use the prepaid card for the kinds of activities typically associated with bank accounts. Large majorities of unbanked households with prepaid cards reported using them to receive income and pay bills. Taken together, these findings raise important questions about whether consumers are aware of potential consequences when selecting from the options available to them. For example, the availability of deposit insurance and certain consumer protections may depend on the product and provider that the households select. The easiest way for most consumers to have confidence that their money is safe and to access key consumer protections is to place it in an insured bank account. For consumers using other options, it is really important that they understand the risks that may be involved. While helping consumers to educate themselves to these ends is an important objective, so too is ensuring that the information consumers receive in the market is accurate and complete. And we've had issues in this area recently. In July, the FDIC finalized a rule to help address instances in which firms misrepresent the availability of deposit insurance in violation of the law. As part of the rule, the FDIC established a portal to allow the public to lodge complaints and inquiries related to such concerns. To date, more than 325 submissions have been made through the portal. In addition, the FDIC took action, issuing cease and desist letters to 6 firms that were misrepresenting the availability of deposit insurance, including some firms that made the claim in connection with offering crypto assets. It's really the two sides of this issue. So as you can tell, the work of expanding economic inclusion is very much ongoing and central to the FDIC's mission. This has consequences for participation in the banking system, access to home ownership, and the economic vitality of communities across the country. I deeply appreciate the work that NAAHL is doing to advance these important objectives, and I frankly appreciate the opportunity today to share the results of some of the FDIC's work. While our recent survey results on participation in the banking system are encouraging, it is clear we have a lot more to do. It's great to see you all this afternoon. I see a lot of familiar faces in the audience. God, it's nice to see people again, isn't it? I mean, really. So thank you all for being here. Thank you for inviting me. And if you don't ask any questions on CRA, I'll be glad to try to respond to you. Thank you all very much.
Thank you, Chair. Thank you, Chairman.
You can call me Marty David, that's okay, yeah.
Not going to ask you about CRA, but I appreciate the work you're putting into it. I'm sure it's no small amount. My question actually is
There's
on
no higher priority that the banking agencies have than to reach a final rule on CRA that will be meaningful and effective and expand access to finance and basic banking services across this country. No question.
Thank you, and I couldn't agree more. On interest rates, we've seen mortgage rates more than double in significantly less than a year. Obviously, we've seen the Fed funds rate move up to 4 points. We're not used to this. Some of us of a certain age are familiar with it. But as a bank regulator, I'm really interested in your thoughts on how banks need to be thinking about managing interest rate risk and how consumers should be managing it.
So I got to tell you, that's another speech. Just so I'll try to give you the short version. But look, as we look across risks to the banking system today, rising interest rates is not surprisingly the core issue. We're focused on the Fed is, well, you saw their action today and the signals they've made going forward. It's already having an impact on economic growth. We've seen it in the first and second quarters of this year and the third quarter as well. There's significant potential downside risk, certainly for the banking system. In this, I should note up front that the banking industry has been doing really pretty well over the last couple of years. And so they enter this period, and I really do think we're at an inflection point in the economy right now, but they do enter this moment in a position of relative strength. As a whole, the industry is well capitalized. It has strong liquidity. Credit quality is pretty strong. So the industry enters the period in a position of strength, but the downside risks are real. They have significant asset exposures that we'll be paying close attention to, particularly commercial real estate. Home mortgages could be another area. There is significant interest rate risk on the balance sheets of the banking industry today. You all may know the FDIC issues a quarterly banking profile. It's sort of a snapshot of the condition of the industry, and we've highlighted this in the last couple of QBPs, as we call them. We've had a prolonged period in which we've had narrow interest margins that our banks have been dealing with. So they've had an incentive to go, as it were, further out on the yield curve, making longer-term loans in order to manage a narrow interest rate environment. And as a result, there's a real concentration of longer-term assets on the balance sheets of our banks. As we pointed out in the QBP, nearly 40% of all the banking assets in the United States today have terms of 3 years or more. And for community banks, that's over 50%. So that's substantial interest rate risk accumulated on the balance sheets of our institutions. And related to that, this is also in the QBP, is a significant buildup of unrealized losses on the balance sheet of our institutions from securities and loans that they're holding on their balance sheets. And if you look at the QBP, we've got a chart that goes along like this and then like that in terms of unrealized losses. Now, as I mentioned, our banks have strong liquidity today. So in the short run, they shouldn't have the need to sell any of these assets off of their balance sheets. But as the economy progresses and the environment becomes more stressed, the liquidity pressures on the institutions can increase. And if they then have to sell some of these assets with unrealized losses in order to meet their liquidity needs, there is significant potential loss accumulated on our banks' balance sheets. So this is a long way of saying the banks have been doing well. The environment is changing dramatically. We seem to be at an inflection point in the economy. Significant downside risks for the banking system going forward. And those are the things we at the FDIC and the other banking agencies will be very focused on.
Marty, thank you so much.
Hey, thank you all. Great to see you.